and welcome back to this week's Manager's Thoughts. This is Kelly from Synergy Asset Management, and we're super excited to give you just a quick update of market news, economic news, and what's been going on this week. So let's get right into it. Alright, so heading into this week, we kind of expected a more volatile week, especially in the equity markets, as the November CPI data came in on Tuesday, and the Fed meeting announcement was on Wednesday. And so we saw inflation fall short of expectations, and we saw kind of the Fed do exactly what we thought they were going to do, which was raise the federal funds rate by 50 basis points. And so they kind of seemed like they're going to hold this quantitative tightening into 2023, which kind of drove markets down. And so as of Thursday, December 15th, the S&P 500 and the Dow Jones Industrial were down 2.4% for the week. The NASDAQ Composite was down 3% for the week, and the yield on the U.S. Treasury 10-year was down about 4.7% for the week. Alrighty, so I just wanted to go a little bit more in depth of the Tuesday inflation report we got from the BLS. They reported CPI at 7.1% and core CPI at about 6%. And we know both of these fell short of expectations of 7.3% and 6.1%. So a pretty significant difference in what was expected and what came out. And so equities really excited about this. They were up as much as 2.6% on Tuesday in reaction to this positive news. And you can kind of see in the chart there that we are actually starting to see a perpetual downtrend just because of the rate hike starting to kick in and just the overall economy starting to cool down. And so since that 9.1% peak in June, you can really see that since then inflation has either been about the same or fallen. And so this is a really good sign, really encouraging for both investors and the Fed as we go into 2023. So if the CPI report wasn't exciting enough for you this week, we also had a Fed meeting going on, right? And so the Federal Open Market Committee met and announced an expected 50 basis point rate hike this week, which was actually the first decrease in the size of rate hikes so far in this tightening cycle, bringing the federal funds rate target range to 4.25% to 4.5%, which is actually the highest level since about the end of 2007. And so you can see in the chart there that really just in the last year or so, rates have just skyrocketed as the Fed has continued to raise rates probably into the new year. And so after this announcement on Wednesday, the S&P fell about 1.3% by close, and on Thursday the S&P tumbled about 2.5% by close, just as investors were becoming increasingly concerned about the possibility of a recession in the new year, and then also just as Powell was really adamant about continuing this tightening cycle to really make sure that they crush down inflation and really bring that down to the 2% level that they aim to reach. Also on Wednesday, we got the Summary of Economic Projections, which comes out at about every other Fed meeting throughout the year. And so this is really just the Fed members' best estimates of where the economy might be heading and where policy might be heading. Definitely not a perfect metric, but a good insight into where they think it's heading. So here you can see the unemployment rate. They expect to go up about a whole percentage point almost into the next year and 2024. They also expect that inflation is going to really come down, specifically in PCE inflation. They're really expecting that to come towards that 2% goal in the next 24 months or so. Also on here, I want to point out that they think the Fed funds rate is going to go up to 5.1% into the new year. And so that's about 60 basis points higher than where we are now. Really interesting just to see where the Fed members are at and where they think the economy is heading. And so just really interesting metrics to look at while we are trading the markets and monitoring markets as best as we can. On Thursday, we got a few more smaller data points of economic news. We also got the retail sales on Thursday as well. And so we got negative 0.6 month-over-month growth from about October to November. This came in about 67% lower than the estimates of negative 0.2% decline month-over-month. And so although this data point is just kind of a small piece of the economic puzzle we're kind of in right now, it's really important to see that Americans might be beginning to cut back on spending, kind of, even though we're in the holiday season and a lot of spending is going on, they might be cutting back in anticipation of a rockier 2023 to come. And so here you can see on the chart that we had positive growth in October, and we had just about flat growth in September, but here we are in the negative in November. So it'll be really interesting to see where this goes into the new year. One other data point we got on Thursday was the business inventories data. And so it fell short of expectations by about 25%, coming in at 5.3% growth month over month from September to October. And so kind of this growing inventories of businesses is good because it's increasing supply, but this also fell short of expectations, which means that, maybe production is slowing faster than we think. So again, just another really interesting data point to watch as we go into the new year. So amidst all of this CPI data, all these Fed meetings and everything, we really look forward to continuing to monitor markets as we close out 2022 and go into the new year. And so we're constantly looking at economic news and different data points to best manage each portfolio per its mandates and per its nature for the benefit of you guys. We are super appreciative of you tuning in to our Manager's Thoughts updates, and we wish you all a happy holiday season as we go into the new year and Christmas, and we hope that you all stay healthy, safe, and happy into this holiday season.